Let's expand the conversation now with bring in CNBC contributors Bryn Talkington of Requisite Capital Management and Greg Branch of Veritas Financial Group. I don't know. The market seems to be trying to rain on your parade, Greg. You've been really negative. I mean, maybe it's starting to sniff out a soft landing. Are you?
I don't think so. And I would respectfully disagree with my colleague that the market is not pricing in. We didn't overprice negative information. I think in June, we were probably appropriately pricing in the information. And I think that once Jerome Powell gave the green light to put risk back on, that's what the market did. I've said this to you before, Scott. I think he made a mistake, and I think his colleagues have been trying to walk that back ever since, culminating with James Bullard on our very channel last week saying that he'd like to see the Fed funds rate at 4%, and he'd like to front load that. The market is certainly not discounting that at this point. And so, no, I don't think that we'll manage a soft landing. The history has shown that we never typically do. And I think that while the duration and depth of this recession might not be what we're used to, given the strong labor market, you can decouple the incident of a recession from a strong labor market. You can actually have both, even though we typically don't.
You want to respond?
Yeah, I mean, I agree. I have to respectfully disagree here, but I think just the fact that we're having such a strong labor market, I think it's hard to say that we're going to have a hard landing here. And anything's possible, right? I mean, I do think it's too early to say that we're out of the woods yet, that we don't necessarily have another leg down. But I'm definitely of the mindset that we have a good possibility of having a better second half of the year here than we did our first. And I think you want to make sure you're positioned as such.
Yeah, so Gregory, I mean, even, Diamond, as we just referenced, the hurricane man, comes back today
right.
or yesterday when he made these comments speaking about how strong the labor market is, suggesting you can't have a recession with the labor market this strong and the way that consumers can continue to spend. How do you respond to that?
Right. I'm going to respond to that in two ways. Let's talk about the consumer first. Yes, the consumer is still spending. That is decelerating. We saw growth in travel and entertainment spending go from 30% in May and June to about half of that in July. But they're also levering up to do that, Scott. And so we had record credit card applications when it's becoming historically expensive to do that. And so we are still spending, but that bill is going to need to be paid. It's a little too early to talk about the losses at this point. I think that will season throughout the year. But at the end of the day, we're seeing that across the socioeconomic spectrum. When those banks reported, they were talking about historically strong loan growth in their private wealth divisions. And so, yes, we're spending, but we're taking out debt to do it. Now, let's talk about the other side of that, about the corporations. Yes, I will admit this earnings quarter turned out to be stronger than I expected. 77% of the S&P beat their earnings on the top line. That's typically 66%, about 70%. 77% on the bottom line, 70% on the top line. That's typically in the mid-60s. But all of them almost universally warned about intensifying challenges, if not with their supply chain, and certainly with inflation and deteriorating consumer demand. That was a constant refrain. I think we will continue to see that. And in terms of decoupling that labor market, remember, it's the absence of labor earnings that determines the depth and duration of a recession. Typically, that's the unemployed population that's contributing to that. Now we're all contributing to that because real wage growth has declined by 4%. We're all facing that hyperinflation. So that's where the weakness that powers the depth and duration of the recessions.
Okay, so let me bring in Bryn, if I may. Is it time, Bryn, for this half-empty view to do a 180 and think that the market may be now time for half full?
Well, I think this conversation with Courtney and Greg really sums up what we're seeing this year, because I don't think I've ever seen in a really long time this bifurcation of people that are really bearish versus those that are, we'll say, glass half full, right? Besides, like, the folks that think we're going to go to 5,000. And I just think that investors are going to continue, Scott, to be frustrated this year, because you have to remember, my thesis is the range of outcomes that can occur is incredibly wide this year because of all the reasons that Courtney and Greg just walked through. Because if you go back and look at probabilities, and if you're investing based on pure probabilities, since 1913, the Fed has only engineered a soft landing around 10% of the time. And then we've had oil shocks. We have so much debt that's been printed. All of the things. We have high inflation. You would think that we would have a hard landing. But I would say, we're in these uncharted waters. And so I think that a lot of people that are bullish are anchoring that inflation comes down meaningfully and stays lower. My problem with that is, being in the energy field down here in Texas, is that, energy's had, a pretty meaningful sell-off, but in the next third quarter and fourth quarter, we're going to have the SPR stop, and then what happens with the Russian sanctions? So if all of a sudden energy starts being meaningfully higher, then inflation isn't going to be lower. And so I think as an investor, I wouldn't anchor either way. I think you still have to be, defensive in your positionings. I mean, that's why we have a lot of covered calls, because I don't think we're going to get this V-shaped recovery. Because you know what? Go back and look the past 15 years. What has been in every single V-shaped recovery? What's been the one ingredient? The Fed. The Fed has been doing QE. Now they're doing QT. And so I think it's going to be kind of in the middle of the two. I don't think it's going to be extreme either way, but I do think investors need to settle in for more of like an L-shaped recovery versus this V that I'm hearing from a lot of the bulls.